people that are watching this, y'all were all invited to come to Canyon Creek. It's right over here.
It says it right there.
Canyon Creek Country Club, and y'all didn't. So y'all are missing out. This is on y'all. Like I can't fix everybody, Eric.
But we can invite them. We can invite them, and
Yeah.
they can come, or they can,
Come get better at social media. Come learn about mortgage. How many years of experience do we have here, Eric? 61 years of mortgage experience. Scott, how many years?
21.
Eric?
24.
Jeez, I'm the young one, 16.
Okay.
16.
Sweet 16, man.
Yeah.
You can drive your mortgage car now.
Scott, tell us about you, man.
I moved to Dallas, Texas, 2005. Been a loan officer ever since. Science degree, teacher, soccer coach.
He's not kidding about the science degree. I get weather updates from this guy all the time when it's tornado season.
Get
Batten down the hatches.
Get to safety. Living the dream, I guess.
Yeah.
Married.
You probably have the coolest
10-year-old.
mascot of any college, I think.
Penn State, we are. Let's go.
Stay.
All right, so what are your topics today? What did your people tell you they wanted to talk about?
All right, so yesterday I got on and did a Facebook Live, and no, I didn't. I just posted it.
Yeah, it was just a post.
I just posted it. So people wanted us to talk about pre-approval versus pre-qualification.
Okay.
Like, I think this has probably been done a lot, but do you want me to go, or do you want to?
Yeah, take it. It's your people.
So yeah, man. So pre-qualification basically means that we've had a conversation and a consultation to start, and then I took a loan application because you wanted to move forward, and then I asked for your permission to pull your credit, which I did, and then based on what you told me, and based on what we put on the application together, I pre-qualified you because you fit inside the guidelines from what you told me. Moving forward, because we want to be more solid than just what you told me, because no offense to people, but sometimes y'all tell me some stuff that needs a little more to it. Like they'll tell you, hey, I make $75,000, but they leave out the part about, hey, I made $5,000 in bonus, and then I made another $5,000 in commission, and to which you gotta have a 2-year history of it. So anyway, moving it forward. So we're gonna collect the documentation from you at that point to where I can add the docs to the file. I'm gonna send it to an underwriter. An underwriter is way more serious than this guy, and they're really gonna put your numbers down from what you sent. They're gonna come back with a conditional.
But you're a pretty smart
approval.
guy. You pre-underwrite your files.
No, yeah, 100%.
We're not
You know
gonna,
what
he's
they're
not,
looking
he
for.
doesn't mean we're going to wait until it's time to go to underwriting to review the income.
I'm just gonna use UWM's Bolt. I'm not gonna lie to you. It's automated, and it's easy. And you get it in 30 minutes.
There you go. Shout out. UWM.
So that's the difference between that. Eric,
Yeah.
you're taking our next one.
Oh, I got the next one?
Rate buy downs. Rate buy downs. This is really big with the builders, right?
Okay.
Rate buy downs because, like, I've got a neighbor, and I know that he's been in his house now for 2 years, and his interest rate was 4.5% when he started.
Yeah.
He's got a 2-1 buy down. What does that mean?
Okay, so 2-1 buy down is a temporary buy down. So when we were in a raising rate environment, it made sense to look at these types of programs because what it helped the customer do is get into a property with a lower initial payment with the anticipation that rates would eventually be coming down. Kind of like the old marry the house, date the rate type of deal, right? So for the first 2 years, the interest rate would actually be lower by effectively 2% calculation of the monthly payment. Now, it's not actually 2% lower. What's happened is you negotiated through your purchase process where the seller is going to create a subsidy account and subsidize your mortgage payment for the difference between what your fully indexed payment is. So let's say you're at 7%, and obviously the difference would be 2%, so you're at 5%. So let's just say that payment difference is $500. So it's going to show a full payment of X, a mortgage subsidy of $500, and then your payment would be the leftover amount. And then the second year, same concept, except it's 1% less, right? So your mortgage payment is still subsidized for that 1% instead of the 2% that it was the first year. And then at the third year, it would be the fully indexed payment. And again, the idea here is that at the end of the third year, hopefully you've transitioned into a new mortgage and rates are lower, or at least you've become more acclimated to the payment that is set when you originally got your house.
Right.
So that's how I'd explain the buy down. But it is, responsible to say there's two kinds of buy downs. There's the permanent buy down and the temporary buy down. The 2-1 buy down is a temporary. A permanent buy down is if you say, I want to pay down 2 points to buy down the interest rate. The interest rate's a 0.5% lower for the full 30 years, right? We're now anticipating a falling rate environment. So I would anticipate we'll see less of the temporary buy downs and maybe even less of the permanent buy downs because people will be anticipating refinancing in the future. Do you agree with that?
Yep.
All right.
All right, cool. That was a good answer, by the way. I really enjoyed
Yay!
it. Like, it was long-winded
It was.
a little bit, but
I tried to talk fast though.
I'm not gonna lie, I really enjoyed it. Like, it did something for me. All right, on to the next one.
Next
Sorry,
one.
sorry. So, sorry, Scott. Why don't bank mortgage loan officers answer their phone?
So when we're talking banks, we're talking about a place where you will go in and typically have checking accounts and savings accounts. They will have their own money. Now, most of those individuals do not have separate licenses. Most of those individuals are bank tellers or they're a branch manager that does 17 different things. Most importantly, they get paid very, very little on a transaction. So, I mean, they like making money, but you're just not that important. You're a piece of the puzzle.
Sure.
So, and because of that, rather than maybe handling 10 or 20 clients at a time, that bank might be handling 200 at a time. So they just don't have the time for you. It's not that there's anything wrong with them. It's just
It's a numbers game.
It's a numbers game, and you're not as important individually as you would be with a broker. That's all we do, and that's all we are is customer service and making sure to help somebody get a mortgage.
Yeah.
That and
I think we've all worked at a bank
Yeah,
at one time.
that's
And
pretty
I personally have felt this. So for me, I think this is what we agreed on.
yeah, we definitely
Is when you're a loan officer in a bank, your operations team is probably in a different state, in a different time zone. Your processing manager is also in a different area. Then your sales manager has 400 loan officers under him or her. And so it's really difficult to answer a question of when's my file going to close because you can't get an answer. You know?
And I had
'Cause-
one time.
and
So
sometimes you're not even allowed to call the processor depending on the bank that you're with.
And my favorite is, let's say it's 6:30 in the evening on a Wednesday, and you have a question about your mortgage that's at a bank. Well, unfortunately, they're closed, and
Yeah.
a lot of those banks have policies in place where you're not allowed to do business outside of the bank. And
That's so
so
funny. Yeah.
you're kind of stuck.
Yeah.
one time, for instance, like it was
Voice just cracked?
so dumb. I think did it crack?
Yeah.
Sorry. So one time, for instance, when I worked for bank, it was stupid because the people were supposed to close on a Friday. So don't ever plan to close on a Friday. This is a bad idea a lot of times. So close on a Thursday, fine. Close on a Monday, any other day but Friday. Trust me on this. It'll save you some grief, just in case something goes wrong. You don't want to close on Friday. I just needed a letter of explanation. This is all I needed, Eric. A letter of explanation to clear this file.
Okay.
You know how long it took from the time I sent that letter of explanation until the time I got clear to close? They were supposed to close on a Friday.
Let me guess.
Go ahead.
Too long?
But what day do you think they closed?
Tuesday.
Tuesday. The answer was Tuesday.
I got it right.
But it took like from Friday when it melted in at noon
Yep.
until Tuesday.
Fed rate drop?
Fed rate drop. Okay, so the last 2 times that the Fed dropped the rate, what happened, Eric? Did mortgages go down?
It's been so long since they dropped the rate. that-
Do you remember that?
Yeah. So
did.
what I know is that the market anticipates what the Fed's going to do. So we know the Fed is going to drop rates a quarter next month. They'll likely start dropping rates today. And then depending on what the Fed actually does will depend if something actually happens with rates. So if they drop rates a quarter, it was expected, probably no change.
Yeah.
If we expect them to drop it a quarter and they leave it the same, rates will probably go up, and vice versa. So
Well, and then to take it a step further, the Fed, after that decision, will then talk about why they made the decision, and that often throws
Yeah.
the mortgage market into chaos. They could say something like, we're very worried about inflation, and we're going to have to think in the future if we're going to keep doing this.
yeah,
And that happened I forget if that was last year or a couple of years ago that happened. The rates were dropped, and we saw mortgage rates go up. I mean, almost 0.5% in
Because they
3
said
days.
they were going to change their stance. Yeah.
Yeah.
And it didn't.
Because of inflation.
So the market does not like uncertainty. So
If you like geeking out on market data, watch the MBS market
Yeah.
while the Fed chair is talking.
Yeah.
I mean, that is a wild ride.
I
Oh,
watched
yeah.
it.
We're talking 20-point swings based on how he answers questions.
And let me say one thing, because just because everyone from political leaders to leaders across the country have said we need to lower rates, it's super important that you understand those are Fed funds, those are short-term interest rates. So absolutely, car loans will get better, bank loans, those things will absolutely get cheaper. That doesn't always happen in mortgage land. So if you're sitting at home and you're thinking, oh, I'm going to wait 6 months or a year to refinance, I'm telling you right now, it is extremely risky, and I could see an avenue where interest rates actually go up and go up a lot, depending on what comments are made. So
Yeah.
please do not think that because we're talking about Fed lowering rates, that means, oh, mortgage rates are going to get lower, so I'm not going to do anything today, I'm going to wait. I just, if you hear one thing, hear that, because just be prepared. I could see an avenue where interest rates for mortgages go up.
Yeah, I can see that too. And I mean, another good plug for our friends is that they're giving us an incentive right now.
Oh, UWM?
Oh, UWM.
Sorry,
oh,
sorry,
word.
sorry.
So right now, UWM is giving Nexa Nation 90 basis points to work with. To be honest with you, I locked in a refi at a lower rate than my purchase was at because of the 90 basis points.
There you go.
It was rate and term, so it was super simple to do. And it was a little bit cheaper than a purchase.
And to quantify that, when we talk about that, it basically means about 0.25%
Yeah.
in interest rate below what the market is.
Yeah.
So when you hear things out there, oh, the rates are this, what we're talking about right now, refinancing, we're below that substantially.
Yeah, it was a good. It's good. It's good. All right, next one. Y'all ready to talk about the bridge loan?
Oh, the bridge loans.
Bridge loans.
Okay.
So what happens is a customer typically wants to buy a house before selling that house, and they need the funds to be able to do it, and maybe the reduction in debt to income ratio to do it. My suggestion to everybody out there, and this is actually the last one to talk about on the sheet. I'll go ahead and get it now. No sheet. No. So the thing on here is HELOC. Okay. So anybody out there right now, you probably have equity in your house if you bought your house a while back, like 21, 19. You probably got a lot of equity, and you got to set up a HELOC before you need the money, because like I get several phone calls. Hey Bo, yeah, I just lost my job. I want to go ahead and sign up for that HELOC now.
Yeah.
And then it's too late because I still have to qualify you for it. So if you're out there and you don't have a home equity line of credit on your house now, do it today. Do yourself a favor. Do it today. Even so, if you don't use a HELOC, they don't charge you anything until you actually use it. You're not paying interest on it. I've had mine open for 8 years. I've never used it. I've never paid anything for it. And what it's done...
You don't have an annual fee?
No, there's no annual fee on it.
Huh, okay.
Nothing. So I paid nothing for it. And to be honest with you, it's bettered my credit score as well, because it's an open line of credit that's reporting to the bureau, and it has a zero balance, but I have $100,000 on it. Never used it, never paid a dime for it. Now that was back in the day. Nowadays, they require appraisal fee, and they may require a title fee depending on where you get your HELOC. But if those people would have done that prior to needing that bridge loan, they would have saved a lot of money and a lot of headache, because on a bridge loan, how does that work, Eric? A bridge loan.
I don't like them. So I sold them for a brief time at one bank. What I can tell you is it's far more expensive than you anticipate it's going to be.
Oh.
Now, I understand there's a lot of banks, there's a lot of lenders, there's a lot of different programs. It is a very niche product. So each bank might have some slight variations. One might be cheaper than the other, but generally speaking, this is my personal experience, they're extremely expensive. So not only do you have to pay up front for the house, you have to have X amount of money set aside in case the house doesn't sell as fast as you think it will. And typically that money is set up into a bond with the bank or some sort of money market or something where it's CD, it's tied up. And when you finally do commence the sale of your property and you are ready to close and do the refinance for the traditional loan on the house, that money doesn't come back to you in most cases. It goes towards the principal payment or principal reduction of the house that you just bought. So a lot of customers think, okay, well, I'm putting 20% down, and yeah, you have you set 6 months of interest aside. And in their head, they're thinking, oh, I've got this furniture I got to put in, I got to buy this basketball goal for my kids, and oh yeah, I've got this 6 months of interest that's coming back to me because I didn't need it, right? I sold my house and I didn't need the extra time. That again, there are other banks out there, and there's different terms, and some might say that's not true for us. So more power to those. But again, my experience is you do not get that money back. And the place that I was at, that's how that went down. And it was pretty frustrating. Even though you explain it to customers, that's like 60, 90 days ago, right? And no one remembers every conversation that you have with your loan officer. And that's why I definitely put everything in emails. Usually when we have that kind of interesting conversations, it really needs to be clear, right? Because just that, like if you're going to buy a brand new home, right, and the escrows are really high, but you don't want to pay those escrows, you want to pay the escrows on the brand new house, right? It's like a couple $100 rather than the $10,000 it's going to be later. We make you sign a hold harmless letter, right? It's the same concept, because 9 months later, when the taxes are due, and you're like, hey, my escrows are up to $15,000 and I'm short, what happened? Like, oh, that's what we talked about. Remember, your escrows went up.
Let me ask you this: what happens if your house doesn't sell within a certain amount of time? How long until both notes are due and they can just take both
They
out?
can. I've heard it's happened, but I don't know any personal experiences. But my understanding is they make you re-up an additional 6 months of interest to cover the next 6 months. And a lot of them will go out to like a year or so if you don't sell the house. But you're right. If something goes wrong, I mean, my understanding is they can take both houses.
Yeah, that's
And you're left with nothing.
That's disgusting. So do us a favor, just get a HELOC. Call Eric, call Scott, call me. Let's get a HELOC for you now.
We have a HELOC,
Yeah.
actually, that you don't even have to call us. You click a link,
Automatic.
you fill it out, you're done in 5-10 minutes max, and then you're approved within a couple days, or if not the same day, and then your funds are dispersed in 5 days. It's insane.
Super fast, and it's super good to have just in case. Like I got mine right after my divorce because I had to write a check for $105,000, which depleted my checking account significantly, and I was kind of worried about what if. But lucky for me, that was 2016, and mortgage was good. In 2016, I made that money back. We did good. But I still have the HELOC, and it's still there if I ever need it. Next question, DPA. I'm doing one of those right now. Scott, you want DPA?
I mean,
You're actually the perfect
briefly,
person to hit that.
briefly, and then you guys can follow up. So we are in a fantastic time. Like if you know somebody, maybe they're first-time home buyer, they're thinking of buying a house, and they think, well, I don't have a lot of money saved up. I've got great credit. It's time for me to buy a house. I don't have, some people will say, I don't have 20%. Obviously, you don't need that. Some will say, well, I've got all of these things, but I don't want to give up all of my money. Well, down payment assistance, that's when we say DPA, that's what we're talking about, down payment assistance. For example, in the state of Texas, we have 17 down payment assistance programs in the state of Texas that NEXA that we have access to. They will take either it could be a soft second, it could be a chunk of money. There are a number of different ways this comes out, but they will give you money to offset your down payment. So let's say you're required to bring 3% as a down payment. We will have down payment assistance that might be 1%, 2%, 3%. I know I received something last week about actually going to 5% so that it covers your down payment and then some of your closing costs. Now, I will say, keep in mind, right, it's not free. There's not like a money tree that banks it's not goodwill. What you are going to have is a little higher interest rate. And so it's a way to offset it. Basically, they say, and I'm using round numbers, I'm not saying this is what it is, but let's say it's instead of 6.5%,
What's the PR on that?
they might say, right, 7 or 7.25%, for example. And in doing so, we can provide a grant or a down payment assistance product that would cover 3% or 4% of your down payment. So a lot of them are income sensitive. but we have multiple ones that are now currently not income sensitive. So if you're a first-time home buyer, which means you've owned or bought a house in the last 3 years, right? If you owned a house 20 years ago, you're actually still considered a first-time home buyer. You are typically eligible, even if you fall outside of the income guidelines. Moral is, it's an awesome time. Down payment assistance is out there. Nexa, because we are such a large broker, we've coordinated with a number of banks where we're the only broker in the United States that has access to some of these products. It's mind-blowing on some of our weekly meetings what we have access to. So if it's something you're thinking about, don't wait to save up money and think, oh, it'll be better. Talk to us now, have that conversation, and put a plan together.
Absolutely. And something else that we've discussed is like we are looking to help and mentor other folks that are out there, right?
Yeah.
Not only other mortgage brokers or mortgage bankers, but also realtors. I think we'd be a great help to a lot of realtors that are out there. Introduce them to social media. I found that a lot of realtors are scared to get on and do this. Like, that's why my side hustle that I started is called Don't Be Scared Social Media. Because this is something that you need to where you could be sitting next to your friends and it's so much more comfortable, like hanging out with your buds and you're just talking about mortgage and you can bounce ideas off of people and come up with ideas for videos. And also for mortgage bankers that are out there, wow, Eric tried to tell me how long ago? Like probably a year and a half, 2 years ago.
It was about 2
right
years
after
ago.
COVID.
Yeah.
We could actually go out, and he was trying to tell me, he's like,
Because
hey,
you couldn't market with the bank you were at.
yeah.
They wouldn't let you
back
be
then I could market.
the
but
money
then-
man Rogers.
Yeah. Mike Cordes said I can be the money man as long as I get the DBA, which I did get. Nexa paid for it. Thank you. So I am the money man, and yeah, I couldn't market myself and I couldn't brand myself, but you know that's the problem with working for a bank. They want you to use their branding, and you know they want you to brand them to where someday you might not work at that bank. I don't know. I've been through 3, and I'm not at those banks anymore. And you know, you have to be able to brand yourself if you want it to last for a long period of time. And this is something that you're going to take as a professional, and you're going to stick with your business. You have to be able to brand yourself 100%, and you can't do that.
I just thought of one for Scott.
What do you got?
Weather this mortgage market. With Scott have
Weather the mortgage market.
Hey, I like it.
I do like it too.
I like
Is that
it.
what we're gonna-
Because he's a weather dude.
Yeah, weather the market with
Yeah.
Scott. I like it.
The market is
Little
it's-
play on words there.
Lending Dad here.
the market is stormy. It's
Yeah.
It's
Torrential. It's a
It's
torrential
hot.
downpour of
It's
information.
Super hot. Super hot. I think the market's hot, and I think it's going to
There's
be
a lot of ways
raining
we can
soon.
go with that. You better get it for someone snagged it right
Yeah,
now.
it's
Right.
going to be raining soon,
Yeah.
so you got to catch it before it rains.
my wife wanted me to be the mortgage ref. I also
Oh.
referee. I also referee on the side for soccer, and she wanted me to that way I could pull out my yellow card and red card and
Okay.
yell
I
at
see.
people. But
I see. My friend Josh Waters has taken the Lone Ranger. I
Okay.
thought that was a good one. Lone Ranger.
Well, especially because you're
LOAN.
Bo Rogers.
Yeah.
LOAN.
Lone
Yeah.
Ranger.
Nice.
We really do want to help market people. So if you,
Come have some fun with us.
I mean, why not? What do you
Yeah.
got to lose? Eric will buy you lunch.
I will.
Yeah.
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 Come on out.
Scott, thank you, bro.
Yeah. Thank
I
you.
think it was good. Eric?
Scott's always good, man.
Yeah. I think so. All right.
You gotta hit the button now.
All right. I got to go.
What? You gotta hit the. Yeah. You got people blowing you up. I see the thing.
Text
going
message. They
crazy.
probably want a bridge loan. I don't know. Don't want a bridge
Well,
loan. Get a
where's
HELOC.
Terabithia?
Get a HELOC. Don't get a bridge loan. My name is Bo Rogers. I'm the money man. My NMLS number 620948. We're Eagle Housing Lender. We love you. Peace out.